In September 2020, the United States Department of Justice announced the largest market manipulation settlement in the history of commodity trading. J.P. Morgan Chase, the largest bank in America, agreed to pay $920 million in fines and admitted to systematically manipulating precious metals markets for nearly a decade. This wasn't speculation. This wasn't conspiracy theory. This was a confession. The bank admitted that its traders placed hundreds of thousands of fake orders designed to manipulate the price of gold, silver, platinum, and palladium. They admitted to deceiving other market participants. They admitted to breaking the law repeatedly over 8 years. $920 million, 8 years of manipulation, hundreds of thousands of fake orders, and almost nobody outside of financial circles knows this happened. This is the story of how the most powerful bank in America rigged the silver market, how they got caught, and what it means for the price of silver today. Before we dive in, if you're new here, this channel exposes how money really works. Not the version they teach in textbooks, the real version. Subscribe and turn on notifications, because what you're about to learn could change how you see the entire financial system. Let's start with what they actually did. The manipulation technique J.P. Morgan used is called spoofing. It's a form of market fraud that was made explicitly illegal by the Dodd-Frank Act in 2010, but J.P. Morgan's traders had been doing it for years before that, and continued doing it for years after. Here's how spoofing works. Imagine you want to buy silver at a lower price than the current market. You could just place a buy order and hope the price drops, but that's leaving things to chance. Spoofing lets you manufacture the price drop yourself. First, you place a large sell order, not because you actually want to sell, but because other traders and algorithms see your large sell order and interpret it as a signal that prices are about to fall. They think someone with a lot of silver wants to dump it, so they start selling too. The price drops. Now, just before your fake sell order gets executed, you cancel it. The order was never real. You never intended to sell, but the damage is done. Prices have fallen because everyone reacted to your fake order. Now you place your real buy order at the artificially lowered price. You just bought silver cheaper than you would have without the manipulation. Then you do the reverse when you want to sell. Place fake buy orders. Other traders see big buying interest and pile in. Prices rise. You cancel your fake orders and sell into the artificially inflated price. This is what J.P. Morgan traders did hundreds of thousands of times over 8 years. Let me be precise about the scale. According to the Department of Justice, J.P. Morgan traders placed literally hundreds of thousands of orders that they intended to cancel before execution. These weren't occasional mistakes or rogue traders. This was systematic, institutionalized fraud. The manipulation occurred across multiple precious metals: gold, silver, platinum, palladium, across multiple trading desks, across multiple years, from at least 2008 through 2016. And here's what makes this even more significant. J.P. Morgan wasn't just any trader in the silver market. They were one of the largest. At various points, J.P. Morgan held one of the biggest short positions in silver futures in the entire market. A short position means they profit when prices go down. They had hundreds of millions of dollars riding on silver prices, staying low, and they had the ability to place massive orders that moved the market. Think about what that means. The bank with one of the largest bets against silver was systematically placing fake orders to push silver prices down. They weren't just trading, they were manufacturing the outcome they needed. The investigation that eventually caught J.P. Morgan started with individual traders. In 2018, the DOJ charged several J.P. Morgan employees with racketeering, conspiracy, and fraud. Yes, racketeering, the same charge used against organized crime families. Michael Nowak was the global head of J.P. Morgan's precious metals desk. Greg Smith was an executive director and trader. Christopher Jordan was another trader. These weren't junior employees making mistakes. These were senior executives running the operation. The indictment described the precious metals desk as a criminal enterprise. Prosecutors used RICO charges, the Racketeer Influenced and Corrupt Organizations Act, which is typically reserved for the mafia. They argued that the desk operated like an organized crime operation with senior leadership directing ongoing criminal activity. The traders kept records. They communicated about their manipulation in writing. They taught new employees how to spoof. It was treated as a normal part of doing business on the desk. One trader literally referred to their scheme as the hammer, as in, we need to hammer the price down. This wasn't subtle. This wasn't hidden. This was how the desk operated on a daily basis. The evidence was overwhelming. Electronic trading records showed the pattern clearly. Massive orders placed, market moves in response. Orders canceled milliseconds before execution. Real orders placed in the opposite direction at the manipulated price, repeated over and over, hundreds of thousands of times. In 2020, rather than fight the charges, J.P. Morgan settled. They agreed to pay $920 million and entered into a deferred prosecution agreement. They admitted to the facts. They acknowledged that their traders broke the law systematically for nearly a decade. The settlement broke down as follows: $300 million in restitution, meaning money paid back to victims of the manipulation. $362 million in criminal penalties. Approximately $200 million to the Commodity Futures Trading Commission. JP Morgan also agreed to cooperate with ongoing investigations and implement compliance reforms. Several individual traders faced separate criminal charges. Now, let me put this settlement in context. $920 million is a lot of money, but to JP Morgan Chase, it's a rounding error. The bank earns over $40 billion in profit per year. They paid about 8 days' worth of profits to make this go away. More importantly, the manipulation went on for 8 years. If they profited more than $920 million from the scheme, which they almost certainly did, the fine is just a cost of doing business. A speeding ticket, the price of getting caught. No senior executives went to prison. The bank continues to operate. The same trading desks are still active. The same market structure that enabled the manipulation is still in place, and JP Morgan is not alone. In 2018, Deutsche Bank paid $30 million for similar manipulation in precious metals markets. UBS paid $15 million. HSBC paid $1.5 million. Merrill Lynch, Bank of America, and other institutions have faced similar charges. This isn't about one bad bank. This is about a system, a market structure that enables manipulation by design. Remember how spoofing works. It requires the ability to place large orders that move markets and then cancel them before execution. In a normal market with normal participants, this wouldn't work. But the precious metals futures market isn't normal. The COMEX, where most silver futures trade, is dominated by a handful of large banks. These banks are the primary market makers. They provide liquidity, they set prices, and they trade against their own customers. It's like playing poker, where one player can see everyone else's cards and also gets to decide what cards come off the deck. The game isn't fair because it was never designed to be fair. The paper silver market trades approximately 300 ounces of silver contracts for every 1 ounce of physical silver in the vaults, 300 to 1. It's a market built on promises, not metal. And in a market built on promises, the players who can create the most convincing promises have the power. JP Morgan didn't just trade in this market. They helped design it. They profited from its structure. And when that structure enabled manipulation, they took full advantage. So here's the question that matters. If JP Morgan manipulated silver prices for 8 years, what about the years before and after? What about the other banks? What about the overall structure that makes manipulation possible? The $920 million settlement covers 2008 through 2016. But silver price suppression didn't start in 2008, and it didn't end in 2016. In part 2, I'm going to show you the 44-year history of silver manipulation, how the current system was built specifically to keep silver prices low, why that system is finally breaking, and what happens when 4 decades of artificial price suppression meets unstoppable physical demand. The JP Morgan settlement proved what many suspected for years. The silver market is rigged. The question now is, what happens when the rigging stops working? In part 1, I showed you how JP Morgan manipulated silver prices for nearly a decade using a technique called spoofing. Hundreds of thousands of fake orders. A $920 million settlement. Senior executives charged with racketeering, the largest commodity manipulation case in history. But here's the thing. JP Morgan's manipulation was just the tip of the iceberg. The suppression of silver prices didn't start in 2008, and it didn't end with the settlement in 2020. To understand what's really happening in the silver market, we need to go back to 1980, to 2 brothers from Texas who tried to do exactly what you might be thinking about doing right now. They saw that silver was undervalued. They started buying. And then they discovered just how far the system would go to stop them. Nelson and William Hunt were billionaire brothers who made their fortune in oil. By the late 1970s, they had become deeply concerned about inflation and the decline of the dollar. They watched the government print money. They watched prices rise. They decided to protect their wealth by buying silver. Between 1979 and early 1980, the Hunt brothers accumulated an estimated 100 million ounces of silver, about a third of the entire world supply that was available for trading. As they bought, the price rose. Silver went from $6 an ounce in early 1979 to $50 by January 1980, an 800% increase in about 12 months. The financial establishment panicked. If 2 brothers from Texas could corner the silver market, what did that mean for the paper money system? If everyone tried to exchange their dollars for real money, for silver and gold, the entire financial infrastructure would collapse. Banks would fail. The Federal Reserve's power would evaporate. So they changed the rules. On January 24th, 1980, the COMEX exchange implemented what they called liquidation-only trading for silver. This rule meant that traders could sell silver contracts, but they could not buy them. Only sell, not buy. Think about what that means. They made it illegal to buy. In a free market, in America, they literally banned purchasing. What happens to any market when buying is prohibited but selling is allowed? The price collapses. There's no support because no one is allowed to provide support. Silver crashed from $50 to under $11 within 2 months. The Hunt brothers faced margin calls they couldn't meet. They eventually declared bankruptcy. And a message was sent. Anyone who tries to challenge the paper money system, anyone who tries to establish the true value of precious metals, will be destroyed. The rules will change mid-game if necessary, but the system couldn't rely on emergency measures forever. They needed a permanent mechanism to keep precious metals prices under control. And so the modern paper-silver market was born. Today, the vast majority of silver trading happens on the COMEX Futures Exchange. These are contracts that represent silver, not actual silver, paper promises. The ratio of paper contracts to physical silver in the COMEX vaults is approximately 300 to 1. For every 1 ounce of real silver that exists, 300 ounces of paper silver are traded. This means the price of silver is set by trading paper, not metal. And paper can be created infinitely. There's no limit to how many contracts you can sell. You don't need to own silver to sell silver futures. You just need capital for margin requirements. This is how the suppression works day after day, year after year. When silver prices start to rise, large traders can simply sell massive amounts of paper contracts. This selling pressure pushes the price down. And because they're selling paper, not real silver, they never run out of ammunition. The banks that dominate this market, including JP Morgan, Deutsche Bank, HSBC, and others, have consistently held large short positions in silver. They profit when prices fall, and they have the ability to make prices fall by selling paper contracts. JP Morgan's $920 million settlement proved this isn't speculation. They admitted to placing fake orders. They admitted to manipulating prices. The crime was documented, prosecuted, and settled. But the settlement only covered one bank's activities from 2008 to 2016. The structure that enables manipulation has been in place since 1980. That's 44 years. Now you might be wondering, if silver has been suppressed for 44 years, why would anything change? What's different now? Two things are different. Physical demand is overwhelming the paper market, and the vaults are draining. When paper and physical markets are in balance, price suppression can continue indefinitely. You push the paper price down, and no one complains, because there's plenty of physical silver available at that price. But we're not in balance anymore. In 2024, global silver demand exceeded supply by approximately 400 million ounces. That was the 4th consecutive year of deficit. More silver was consumed than was produced. Where did the extra silver come from? From stockpiles, from inventories, from the vaults. COMEX silver inventory has declined 65% since 2021. London vaults report similar drawdowns. The physical silver that backs the paper promises is disappearing. India imported over 300 million ounces of silver in 2024, the highest in recorded history. They're taking delivery and shipping physical metal east. It's not coming back. China is doing the same. They need silver for solar panels, for electronics, for electric vehicles. They're securing supply, not trading paper. The paper game works as long as everyone accepts paper settlement. It works as long as no one demands delivery. It works as long as there's enough physical silver in the vaults to maintain the illusion. But the illusion is cracking. In March 2020, during the pandemic panic, physical silver premiums exploded while the paper price crashed. Dealers were charging $30 for silver coins, while the COMEX price showed $12. The paper market said silver was worthless. The physical market said, try finding some. That was a warning shot. The divergence between paper and physical is growing, and at some point it breaks completely. When the paper game breaks, prices don't adjust gradually. They reprice violently. In 2022, the nickel market experienced a short squeeze on the London Metal Exchange. Nickel prices doubled in a single day. The exchange had to halt trading and cancel billions of dollars in transactions. The paper market broke because there wasn't enough physical nickel to cover the paper promises. Silver has the same setup. Massive paper short positions held by banks, depleting physical inventory. Exploding industrial demand with no substitutes. 4 consecutive years of supply deficit. The manipulation that JP Morgan admitted to was just one piece of a system designed to keep silver prices artificially low. But that system depends on conditions that no longer exist. There isn't enough physical silver to meet current demand. Inventories are draining at an accelerating rate. Industrial users are starting to stockpile because they can't risk supply disruptions. And the paper market is still priced as if supply were unlimited. This is why silver at $64 is not expensive. It's the price set by a manipulated paper market that is increasingly disconnected from physical reality. The J.P. Morgan settlement proved the manipulation is real. The inventory data proves the shortage is real. The demand data proves the supply crisis is real. What we don't know is the timing. When does the paper market break? When does price discovery transfer from paper promises to physical metal? When does silver reprice to reflect actual supply and demand? Nobody can predict the exact moment. But the direction is clear. Paper markets require trust. When the vault's empty and delivery demands can't be met, trust evaporates. And so does the paper price suppression. JP. Morgan paid $920 million to settle charges that they manipulated silver prices. They admitted guilt, they paid the fine, and they kept trading. But the physical market doesn't care about paper games. The solar panels need real silver. The electric vehicles need real silver. The electronics need real silver. Every ounce that leaves Western vaults and heads to manufacturing facilities in Asia is one less ounce backing the paper promises. Every year of supply deficit draws down the stockpiles further. Every new solar installation increases demand that can only be met with real metal. The banks can manipulate paper. They cannot create physical silver. This is the situation that almost nobody is talking about. A proven manipulation scheme, a structural supply crisis, depleting inventories, and a price that still reflects the manipulated paper market rather than physical reality. At some point, physical reality wins. It always does. Paper promises are only as good as the ability to deliver, and the ability to deliver is shrinking every day. The question isn't whether silver is manipulated. J.P. Morgan admitted that. They paid nearly $1 billion to settle the charges. The question is, what happens when the manipulation can no longer hold? What happens when the vaults run dry? What happens when industrial users panic and demand immediate delivery? What happens when 4 decades of artificial suppression meets unstoppable physical demand? The math says we're heading toward that moment. The inventory data confirms it. The settlement proves the manipulation was real. Now, you know what most people don't. The largest bank in America admitted to rigging the silver market. The structure that enabled that rigging is still in place, but the physical conditions that allowed it to work are disappearing. If this video opened your eyes to what's happening in the silver market, share it with someone who needs to see the evidence. Subscribe if you want to keep learning about how the financial system really works, and ask yourself this question. If a bank paid $920 million because they got caught manipulating silver prices, and the system that enabled that manipulation is still operating, and the physical silver that backs the paper promises is draining at 65% in 4 years, then what is silver actually worth? The manipulated paper market says $64. The math says something very different. I'll see you in the next one.